All right, welcome back to part 3, the review of financial accounting, or ACC 201. So remember what we were discussing before. Each account has a general ledger, which is basically demonstrated with debits on the left, credits on the right. But before we go and post any debits or credits to any of the general ledger accounts, as business transactions come up, we record them first in our journal with journal entries for the debits and credits. So let's go through a couple examples. And again, keep that slide number 1 from the handouts for Chapter 1 handy. It will help a lot with this. So on March 30th, Harriet the haircutter of Hollywood paid $600 cash for March rent, right? So we ask ourselves that same question. We're spending cash here. Why are we spending cash? Are we getting something in exchange, like an asset that will give us a benefit in the future? Or have we used up all the value already when we pay out this cash? And in this example, we're paying for the last month's rent, so we've used up all the value, right? In theory, that $600 cash helped us generate revenues during the month of March, which it's already March 30th, so we've used it all up. It needs to be expensed, and we want to match this expenditure with the revenues that it helped us generate. And in theory, it helped us generate revenues in the month of March, right? We couldn't have run our business if we didn't pay rent for it in the month of March. So what do? Well, we need to show a decrease in cash, which is an asset, which is a normal debit balance. So to show a decrease in cash, we do the opposite. We credit it. And why are we spending that $600? Oh yeah, we used it up already for services in March, right? To help us generate revenue in March, we need to expense it. So to show an expense, an increase in an expense, we of course credit it. In this case, it's the rent expense account, and we've paid cash. So we credit cash to show the decrease, debit rent expense to show the increase in the expense. Next, same day, Harriet the haircutter prepaid $7,200 cash for the next 12 months of rent. So we just paid the rent for the month before, and now we're paying for 12 months forward. We're spending cash again. It's going to be a credit to cash, and the debit here is to prepaid rent, which is an asset account. Now, as we start using up that prepaid rent, right after a month, we will have used up, and by the way, for 12 months, you just divide this to figure out what a monthly rent amount is. It's $600. So at the end of April, for example, we would want to reduce the prepaid rent account by $600 by crediting the prepaid rent account, right? If we're increasing it here with a debit, to show a decrease in it, we would credit it. And of course, at that point, when we've used up $600 of the prepaid rent by using up a month rent, we would then take a rent expense at that time. So not until we use up that asset, and that asset helps us generate revenue, do we recognize an expense. In this case, remember, we are exchanging cash, but for an asset, something that we now own. The legal right to occupy this establishment and run our business out of it for the next 12 months, which will, of course, benefit us in the future. Next, April 3rd, Harriet the haircutter of Hollywood purchased equipment for $12,000 and supplies for $2,400 from Big Beauty. It's a big supplier for us on account. We're not paying cash, right? So 2 asset accounts, right? Equipment and supplies need to be increased. Assets are, of course, normal debit balances. To show increases in them, we debit them. And we haven't paid cash here. We owe Big Beauty, so we have to credit a liability account called accounts payable, Big Beauty specific. April 6th, Harriet the haircutter of Hollywood cuts Anna's hair. That's a client of ours, and we immediately receive $2,000 cash. Very simple here. Cash is an asset. To show an increase in an asset, we debit it, right? And to show it, what else? Why are we getting that $2,000 cash? Do we owe Anna $2,000 worth of services, or have we already provided it? Yeah, here we've already provided the services, right? We already cut Anna's hair, so we've earned that $2,000, and when we earn something, it is revenue. To show an increase in revenue, we, of course, credit it. Remember, if you're unsure how we show increases and decreases, look at that magic slide number 1 that was part of the handouts for today's class. All right, looks like we're getting some real famous customers now. Harriet the Haircutter of Hollywood completed an $8,000 project for the Beeb, who obviously has very intense hair and needs it. I think, by the way, this is his mugshot when he got arrested for something. Not sure what, but I thought you guys might enjoy that. And the Beeb has not paid us, but he must pay in the next 30 days. He's a regular customer. We can trust him to pay us. So, we haven't received any cash. Have we earned any revenue here? Yes, we have, right? Because we completed the project of cutting this crazy hair. So once we have earned it, we must record revenue. Remember, to show an increase in revenue, we credit it. We didn't get cash, but that's okay. He's going to pay us, right? So we have an account receivable, which we are also increasing, which is an asset. And to show an increase in an asset, which is a normal debit balance, we debit it, of course. April 13th, Harriet the Haircutter paid $14,400 cash to settle an account with Big Beauty. Remember when we bought that equipment and those supplies from her? We owed her that, right? We had an account payable that we had credited at that time, a liability. Well, now that we're paying it off, we need to decrease the liability, the amount that we owe, by crediting it, and we need to show a decrease in our cash by crediting that. So debit the accounts payable to show the decrease in accounts payable, credit the cash to show the decrease in cash. April 22nd, received $6,400 cash as partial payment from the Beeb, right? He's just now paying for his haircut. Well, he owed us money, right? The account's receivable, and that's an asset. Now that he's paid it, he no longer owes us the money, so we need to show a decrease in his accounts receivable, which is a credit to the accounts receivable. And of course, we're receiving cash. We need to show an increase in cash. To show an increase in any asset, we debit it. April 25th, Harriet the Haircutter completed work for Claire for $2,640 on credit, right? Keywords there, completed work. That means we've earned it. That means it is revenue. We are going to credit the revenue to show an increase in revenue, and of course we did not receive cash, but Claire owes us the money, so we would debit the accounts receivable to show an increase in the receivable amount. On April 28th, Harriet withdrew $6,200. This is the owner herself withdrawing cash from the company for personal use. Cash is going down, which means we'll be crediting the cash account, and the owner's withdrawals have increased, so we will be debiting those. Again, remember, after each one of these transactions, if we were to be totaling all these, our accounting equation will remain in balance. Debits must always equal credits for every single journal entry, and there will always be at least 2 accounts, sometimes 3, sometimes 4. But no matter how many they are, the total credits dollar amount must equal the total debit dollar amount as well. All right, on April 29th, Harriet the Haircutter purchased $800 of additional supplies on credit from Big Beauty Credit. I think we know this. Increase in supplies of $800, that's an asset account, we would debit it, and of course to show an increase in the liability, the amount we owe Big Beauty Company, we credit the liability account. April 30th, Harriet the Haircutter of Hollywood pays $700 cash for the April electric bill, right? The month that just passed. So ask ourselves, we're spending this cash. Are we getting an asset that will benefit us in the future, or have we used up the $700? If we've used it up, which we have in this example, it's an expense. So it's a decrease of cash no matter what, but in this case, we're not getting an asset. We've used up the $700 of electricity during the month of April. That expenditure of $700 in utilities helped us earn revenue in April, right? Couldn't have run the hair salon without electricity. So we are matching the expenses with the revenues that they helped us generate. All right, I hope that's enough examples of the journal entries, and this stuff is all ringing a bell. Let's go over service companies, is what we did in the first half of financial accounting, and most financial accounting classes do the same. Service companies are made up on the income side basically by revenue minus expenses equals your net income, and if expenses are greater than your revenues, of course, you'd have a net loss. Merchandising companies, on the other hand, buy and sell products to earn revenue. Their revenue is referred to as sales, right? Same exact concept, treated exactly like revenue, but it's called sales when you are buying and selling goods as opposed to services. Now, merchandising companies have one very large expense that service companies do not, and that is the cost of the goods sold, right? The cost of the inventory that they sell. If you subtract those two, your revenue or sales minus your cost of goods sold, we get ourselves a new subtotal called gross margin. And that's basically the percentage that they are profiting just based on the cost of goods sold. Remember, it's not true profit because we haven't taken out into account all the rest of the expenses for the company. Once you subtract those out, you get yourselves a net income. But these are the two differences side by side of a service company and a merchandiser. Both have revenue, they're just called something different. But merchandisers have that one very large expense, cost of goods sold, or the cost of inventory, which service companies do not have, and really just one subtotal. Everything else is the same for the two of them. Now let's take a look at an example for a merchandising company. Let's say that now Harriet the hair cutter of Hollywood decides to start purchasing and selling hair gel, okay? So in this example, purchases hair gel for $1,400 cash plus $50 tax plus $150 shipping to get their hair gel to our salon so that we can sell it. Now, the total of all that is $1,600 before we get those items on our shelves ready for sale, and we pay for it in cash. Here's what the journal entry looks like. The two accounts that are involved here, and it's only two, is cash is going down $1,600, right? And merchandise inventory, a new asset, is simultaneously increasing by $1,600. And why not record an expense at this point? Well, because remember, what we are getting in exchange for all of this, the $1,400, the $50 in tax, and the shipping, what we are getting is inventory. We are getting an asset that we are going to sell in the future. And we could not have gotten this if we did not ship it to ourselves, if we did not pay the taxes on it, and we did not pay the price. All of this equals the cost of our asset. And remember, we record things at cost, particularly assets. So we've received ourselves an asset of $1,600. Inventory and cash has been spent, $1,600. Remember, this came from about chapter 5 and chapter 6, if you took it with me. Somewhere midway in most financial accounting classes is when merchandising companies start coming up. So remember, we went out and purchased merchandise inventory, and every piece of cost that gets those items that we sell ready for sale in a position that a customer can pick it up and pay for it, every cost getting it there must be imputed into the cost of the inventory, not expensed until we sell the inventory, right? Because when we sell the inventory, we will have earned revenue, and it took the inventory, the cost of that inventory, to help earn us that revenue. So we would match the cost of the inventory as an expense in the same period of the revenue that it helped us generate. Let me show you what I mean. 3 months later, we sell all that hair gel, let's say to one customer, okay? We bought it for, let's say, all that $1,600 worth of hair gel that we purchased on August 3rd, right? We exchanged one asset for another asset. Fast forward now, 3 months later, we sell all of that hair gel for $2,400 cash to, let's say, the Beeb. So we're getting $2,400 cash, obviously, and we've given over the goods to the Beeb, so we've earned it. So that's revenue, which remember is called sales in a merchandising company. Now, there's a second part to this. Remember, every time you're a merchandising company and you make a sale, there's two journal entries. So this is the revenue side right here, but there's also the inventory side, right? We no longer have $1,600 of merchandise inventory. We need to show a reduction in the merchandise inventory, and we need to show the expense for that now at this time. So we reduce our merchandise inventory by $1,600, the cost of whatever that product was, and we increase the expense that goes with it, right? The cost of goods sold expense, that new large expense that only merchandising companies have. And now we've matched the expense or the cost of the inventory with the revenue that it helped generate, both on November 3rd, not back in August when we purchased the merchandise inventory. Remember, and that goes back to that matching principle, which requires matching the cost and expenses with the sales revenue. So, August 3rd, we purchased merchandise inventory for $1,600 cash. On November 3rd, We sold that merchandise for $2,400, so we don't take the expense of inventory, which is called cost of goods sold, until we actually make the sale. Now, this is a real simple example, and that's why I have this red text spinning bizarrely on the screen for you. Let's take a look at a more complicated problem, which we ran into midway, a little bit further into financial accounting. Let's say, of course, that we go out and purchase 2,000 bottles of hair gel for $10,000. Real important that that's $5 per bottle. Well, when we make that purchase, of course, we're getting inventory of $10,000, right? But they were $5 per bottle. 2,000 bottles. Now let's say the price goes down to $4 per bottle, so we go out and spend another $10,000 and we get 500 more this time with this purchase because it's quite a bit less expensive. So same journal entry here, right? But we've got now 4,500 bottles of hair gel at different costs. So in the future, when we make a sale on November 3rd of 160 bottles, or $2,400 of hair gel, what's the cost that we input there? Are we assuming that we sold the $4 bottles, the $5 bottles? Do we know? We don't know. It's not that simple, right? Some companies do track every bit of merchandise inventory by barcode scanners or some way to know exactly what was paid for it, but not every company does. Companies like Amazon and large-scale companies that have a lot of logistical things may use that, but even they may not. Most companies, instead, they're not in the business of following their inventory. They're in the business of buying and selling stuff and want to make inventory cost tracking and accounting as simple as possible. And that's why we learn the first in, first out cost assumption, last in, first out, or weighted average method, which just assumes something, and it doesn't even have to be based in reality. It just assumes if you follow the first in, first out assumption, for example, you assume that the first or the oldest inventory that you have is the first inventory to be sold, and you follow and track that cost. The good news is, in this semester, you will not have to use or remember first in, first out to a very detailed level, but the concepts are going to be pivotal. The other good news is that, of course, we're going to be dealing with far more cerebral concepts, because we won't just be dealing with merchandising companies, but specific merchandising companies called manufacturing companies. And that brings us to the end of the review for financial accounting. I will see you guys in Chapter 1 of Managerial Accounting. See you soon.